Investment term for the day: refunded bond.
Refunded bonds, which are a subset of the municipal and corporate bond classes, are bonds that have their principal cash amount already held aside by the original issuer of the debt. This is often accomplished through the use of sinking fund, an account a firm uses to set aside money earmarked to pay off the debt from a bond or other debt issue. The sinking fund gives bond investors an added element of security. A refunded bond should not be confused with a pre-refunding bond, which is a debt security that is issued in order to fund a callable bond. With a pre-refunding bond, the issuer decides to exercise its right to buy his bonds back before the scheduled maturity date. Refunded bonds are low-risk investment because the principal amount is already accounted for. The funds required to pay off refunded bonds are held in escrow until the maturity date, usually by purchasing Treasury or agency paper. Refunded bonds can also be referred to as pre-refunded bonds or prior issues. By definition, the term refunding means refinancing another debt obligation. It is not unheard of for municipalities to issue new bonds in order to raise funds to retire existing bonds. The bonds which are issued to refund older bonds are called refunding bonds or pre-refunding bonds. The outstanding bonds which are paid off using proceeds from refunding bonds are called refunded bonds. Put differently, a refunded bond can be construed as a bond of a prior issue that is refinanced using a refunding bond. Payments on refunded bonds are considered equivalent in quality to treasuries, which are backed by the full faith and credit of the U.S. government. After passing through a binding escrow account, refunded bonds will typically be AAA rated due to this cash backing system and as such will offer little premium to equivalent term treasuries. In addition, refunded bonds maintain a tax-exempt status for federal tax purposes.
And that was your investment term for the day.